Good afternoon and welcome to what is already the fifth in our series of What ESG Investors Want. And as you know, this format gives you an opportunity to hear directly from ESG investment thought leaders about their priorities, their areas of focus, and their views on the direction of this market. Today's topic, I think, is incredibly pertinent and important, which is transition finance. As many of you will know, 2020 saw the introduction of a number of new transition finance standards, be that from the Climate Bonds Initiative and indeed from ICMA as well, and really all part of a broader ambition to make the sustainable debt market more representative of the real economy, the real sources of carbon emissions and decarbonization opportunities. So I think a lot to discuss there in terms of transition finance, credibility, and direction of travel for the market. Very pleased to be joined by another panel of leading ESG investment analysts. We have from Deca Invest, Anna Apakina. We have from Insight, Joshua Kendall. We have from Ostrom, Nathalie Bouvier-Rhodes. And we have from AllianceBernstein, Salima Lamdoua. In terms of the format for today's event, again, like with past formats, I have prepared a series of questions for the panel that will take us probably about 40-45 minutes. And afterwards, you have the opportunity to ask any follow-on questions that may arise, either in written format or indeed by raising your hand. We'll split the session up into three subtopics. We'll first talk about transition drivers at the investment houses themselves. What kind of input, what kind of direction are they getting from their end clients, the asset owners? Then we'll look at development of transition standards, the kind of due diligence the investors are undertaking. And then finally, we'll look at the solutions, at the instruments. What kind of transition finance instruments do investors think are credible and investable? So with that, let's commence with the first topic. So really the investor drivers here. And Joshua, I'll start with you. At Insight, what kind of interest and questions are you getting from your clients around this transition theme?
Well, thank you very much for the invitation to join you this afternoon. Appreciate the chance to speak about this important topic. Before answering that question directly, I think it's important just to explain a bit more about Insight, if I may. We're an institutionally led asset manager, meaning we service large institutions like sovereign wealth funds, corporate pension schemes, insurance companies, across mostly fixed income securities and financial risk instruments as well. This institutional client base is, of course, has very different challenges and needs to maybe a retail audience. And I identified two types of clients, essentially. We have risk-focused clients, and we have clients which have values and want to embed those within the portfolios that we run on their behalf. So we turn our attention to maybe the risk-focused clients first, which are the core client base that we see at Insight. For them, transition isn't necessarily a topic that we have many engagements with them on. Indeed, they see transition issues as being part of the general ESG risk parlance that we obviously will have engagements on. It's not differentiated from climate risk. It's part of the overall risk analysis that we'll undertake. So their understanding of transition risk is very much, you have to manage all the risks that we are on their behalf for their fixed income portfolios, and therefore our responsibility is to explain more about the processes involved in our management of those transition risks. So we would explain how we do that through the monitoring of climate risk issues, the development of proprietary rating signals, as well as how it's incorporated into both the bottom-up analysis and through our engagements with companies and other stakeholders as well. So that risk perspective is something consistent for our clients, which are concerned about managing the bottom line and ensuring that we're cognizant of those risk factors and able to tackle them. But there is this growing number of clients that have values. And these values may come from corporate sponsors, they may come from other areas, but we certainly see a trajectory which is this is becoming more relevant. And this is being baked into mandates that we run on their behalf and how they challenge us as investors and the management and the direction of travel for their portfolios. And it's for those values-based clients where we see a variety of different ways in which they will embrace the idea of transition. The first is they might set specific targets regarding climate change or broader environment themes. That could be something maybe quite basic, such as having carbon emissions lower than a benchmark, or it could be identifying the worst in class, investing only in the best in class. There's lots of variety, and clients are having the options to develop the transition narrative for their own portfolios, which is something that never existed just a few years ago. In addition to those set targets, it could also be about allocating towards positive impact themes. And of course, we'll come on to talk to you all about the impact bonds market and how that can be part of it. But certainly for our clients, they recognize that the transition isn't something that is about risk management, even though that's important. It is also about creating and allocating towards those positive themes, which are clearly an opportunity to diversify the portfolio and ensure that our portfolios become more resilient, given the challenges that we see regarding the low carbon transition.
Thank you, Josh. I think that's a very helpful context indeed between the different client populations and drivers. And I guess, Anna, turning to you and your work at DECA, and of course a large German retail client base as well. How knowledgeable would you say some of the retail clients are around the transition topic?
Hello, everyone. I'm glad to be here as well. Yes, at DECA we offer retail funds to German savings banks, and we have seen a lot of interest in climate-related topics. Actually, research shows that clients are more likely to invest in climate-related topics compared to pure ESG topics. And there are some reasons to this as well. For example, they are more emotional about this, or for example, there are more clear standards. There are so many definitions of what ESG is. There are, of course, some labels and standards, mostly on the national basis level, but actually there is no clear golden standard what ESG exactly is. Whereas, for example, if we take a green bond, a climate-related instrument, there are clear standards. There is it's understandable for many of our clients. It's clear, and clients feel emotional about this. And when we come to transition, I think we have some way to go there, because even for a green bond, we will quite often get a question if we have an impact portfolio and clients see a green bond from a large utility or like large energy company, and they will know that the company is not exactly green on its own, but yet we're trying to invest in green projects with these bonds. They will still ask questions whether it's clear, whether the standards are good. They will feel uncomfortable with such investments right away. And here, when we come to transition finance, it will be another step away from just pure green investment. We will have to convince our clients that it is needed, and even investing, for example, in some gas infrastructure, switching from coal is very important for mitigating climate change, although many clients will feel uncomfortable about it at the first place. And for this, we can learn from the green bonds, and exactly this positive marketing the clients have enjoyed about green bonds. These clear standards are very, very important. So it's not us, DECA, for example, who are setting standards, which is quite often with ESG is the case. We have our internal standards and we show clients, and clients ask, and who made up these standards? And we're saying, yes, we developed, it's industry standard, or we're even stricter. But it's not the same as, for example, when EU is giving the standard, or International Capital Markets Association. So it is very important for us to build credibility with our retail clients. And of course, I think good positive marketing will be also beneficial. Green bonds have been around for a while, and the term transition we've been for finance, we've been talking about for a couple of years, maybe. I think with the retail clients, we really have a way to go, and we're working on it as well.
Great. And I guess turning to you, Natalie, of course, over the past 12, 18 months with the COVID pandemic, that's clearly had quite dramatic effects on sustainable finance and thinking in this area. And perhaps turning to transition, how has your own thinking and prioritization evolved when it comes to transition?
Yeah, sure. Good afternoon, Arthur. Good afternoon to everybody. I'm also very pleased to be part of this panel and have the opportunity to discuss transition. So to come back to your question regarding our thinking on transition, I think it has evolved in two ways. The first one is that in terms of strategical importance for us, and the second one would be more in terms of definition. Let me detail maybe a little bit. So transition has become a key topic within our investment policy, and there are several reasons for that. Of course, the first one, we are committed to fight climate emergency. We are conscious of the role that private finance can and has to play to shift capital to greener investment. But I think there are also many other reasons. First one, another one would be climate materiality. You know, in many industries, transition is material in terms of credit risk, especially in high emitting sectors. And as an asset manager managing more than 400 billion of assets, mainly in fixed income, we need to take into account that risk. This is part of our fiduciary duties. And to be honest, there are also other reasons. We are facing some political and regulatory pressure to support the transition. And if you ask me, this is great. For instance, from a political standpoint, you know, we have the announcements of the EU Green Deal, of the EU carbon neutrality target by 2050. From a regulatory standpoint, we are required to disclose more and more extra financial data. You know, in France, we've been used to that since 2015 because we have this famous Article 173 of the law on the energetic transition. But now in Europe, we have to comply with the non-financial reporting directive. We also have to implement the TCFD recommendation, which is now a must-have, or should I say a must-do. And also as an investor and asset manager, we have to very soon report on the alignment of our investment within the taxonomy. And as Joshua mentioned before, we also have pressure from our clients because, for instance, one of our main clients has joined the Net Zero Asset Owner Alliance and is thus committed to carbon neutrality of its investment portfolio by 2050. And we have to support him to achieve this target. So many factors that explain why transition is really becoming core in our investment strategies. And to maybe give a little bit more color to my second point about the concept of transition itself, you know, the definition we have on transition is more and more moving toward the just transition angle. What do we mean by that? I mean, there is currently no, I would say, official definition of just transition. Let's say that it's a concept that combines both the climate and environmental dimension with the social dimension, and even, according to us, with the local territory development dimension. You know, it's a kind of a transition to a low carbon economy, yes, but it has to be resilient, respectful of biodiversity, and inclusive. And we think that it's a concept that makes more and more sense in current context, as you mentioned, especially with COVID crisis that has increased dramatically the social and territorial inequalities. But also, I think it's a concept that gained more and more political support. We found it in the preamble of the Paris Agreement in 2015. We also found it in a dedicated report of the OECD in 2015. It's also a concept that we find in the SDGs, which both cover environmental and social targets, but also in the just transition mechanism of the European Green Deal, and finally in the taxonomy with the do no significant harm and the minimum social safeguards. So I think it's really a concept that is gaining traction. And how do we integrate this concept into our activities? Well, we are very important investors in sustainable bonds. We have roughly 12 billion euro of green, social, and sustainability bonds. And now when we look at green bonds, we also look at the social impact of green bonds, or at least to which extent the issuer take into account the potential environmental and social externality of the green bonds. How do they manage them? We also engage on these teams with the issuers, and we also try to develop strategies or thematic funds for our clients that focus on tailor-made selection of assets and transparent impact reporting that take into account both green and social impact. I guess that's the main point I wanted to illustrate, yeah.
No, that's perfect. And as you rightly illustrate, it's a bit of a perfect storm for this topic in terms of regulatory, political, and indeed bottom-up client drivers. Of course, when it comes to your communication with the asset owner, the data element is important, right? Proving that you are considering transition factors in your strategy. And I wonder, Salima, from your perspective, what role is data availability playing sort of fintech and new initiatives to sort of better define this theme?
Look, just to put everything in context, there is no doubt that the climate transition is a huge area of focus for the broader industry, effectively. As part of our endeavors to be at the forefront of developments at AllianceBernstein within this space and broader climate issues, we joined the IIGCC in 2019, and in the same year, we partnered with Columbia University's Earth Institute. That partnership, the initial tenet of the partnership was to educate our investment staff on climate science, but that partnership has since deepened pretty meaningfully, and we are partnering with the scientists at the Lamont Doherty Earth Institute on various research topics, as well as trying to give them some financial perspective on some of the topics that they look at. But I guess beyond the recent hype on transition, we believe at AB, we believe ESG integration is part and parcel of good fundamental analysis, and we have always integrated ESG in our investment process. And for highly carbon intensive sectors, transition has always been a key factor that we've been looking at. Back in 2012, 2013, our utilities analyst in Europe put out an investment thesis whereby he wanted to go long utilities in Southern Europe versus some of their peers in Northern Europe. And one of the main tenets of that was the investment that these companies were making towards renewables. So the ESG scores that we assign to our issuers are directly embedded in our fundamental scores, and for carbon intensive sectors where the environmental factor is highly material, there will be an element of transition incorporated in this. As you said, I mean, yearly, quarterly, monthly, there are new data sources and new tools becoming available to investors to understand and quantify ambition and impact of transition plans. And this is something where our partnership with Columbia University has really helped us stay at the forefront of all these developments and assess which tools are material, relevant, what are the shortfalls of some of the tools in some sectors versus others. And really, we seek to incorporate all of the data that we find to be material and relevant into assessing transition plans for the issuers that we cover. Another area where transition is important to us is on green KPI linked and other ESG structures. We have developed a proprietary framework for assessing green bonds, and a key part of this framework, and that is dating back to a few years before it became a topical subject, was to see how the green bond fits within the overall sustainability or decarbonization strategy of the underlying issuer. And we've always seen green bonds as an enabler of a top-down ambitious transition plan, as opposed to we've always tried to avoid green bonds where we felt they were more of an idiosyncratic attempt at lowering the cost of capital for certain issuers. As Natalie mentioned, we are also cognizant of the regulatory pressure that investors and issuers are going to come under. And so identifying those issuers that are better placed to transition is going to be key to not only be impactful, but also unlocking alpha over the longer term.
Thank you very much, Salima. But before we go to the section on standards and due diligence, I wonder if there's any other comments anyone in the panel would like to raise, anything we haven't covered when it comes to investor drivers around this theme. Please unmute if that is the case. I don't think so. So we'll turn to the next topic, standards and due diligence. And Anna, perhaps turning to you, there's clearly, particularly in recent years, been a whole raft of new company long-term environmental targets, net neutral by 2050, by 2040. How do you assess these, and how do you assess whether they're credible?
Yes, that's true. We would like more and more companies to set targets, and there are few initiatives appearing now, like science-based targets initiative or transition pathway initiative, where which companies join with commitments to adhere to Paris Agreement with 1.5 degrees Celsius or well below 2 degrees Celsius commitments. And of course, we would like to see from companies commitments to report on this progress. But environmental is not limited only to CO2 reduction. We are also looking forward to companies setting more and more targets when it comes to other environmental problems like water use, waste management, and so on. And we also would like companies to be more ambitious on setting those targets. I'm sure we are going to talk about the instruments going forward, but just noticing that one instrument that is used for transition is sustainability-linked bond, and sometimes the targets we see there, we say we could have had more ambitious targets there, for example. So we would like to see more ambition there, and committing to reporting the progress, because our clients also ask, especially retail clients, they want to know after 1 year of investment, 2-3 years, what have we done, what have we achieved, have we saved any CO2 at all, or have we saved some liters of water, and we have to aggregate it on a portfolio level, which is not that easy, and make it available to our clients, and the more companies report on those issues, the more positive marketing we can make for transition bonds and for all the labeled securities to our retail clients.
So those are very good points, and I hear you that this isn't just about a CO2 transition narrative; that there are a number of other environmental metrics that are relevant here. Josh, when you were speaking earlier, you mentioned the risk-focused client, and indeed you spoke about your own risk models where transition factors are incorporated. Can you dive into a bit more detail as to sort of how that analysis is done when you look at a company with a transition story or need?
Pleased to. So the origins for our climate risk model actually go back to the TCFD initiative back in 2017, where we're asking ourselves the question, how do we as a fixed income investor evaluate the climate risks facing a company? Now, typically, most fund managers will rely or use a third-party environment rating. But there's a number of challenges with that. It's a bit of a black box. You don't quite know where a company is on a trajectory scale. There's lots of inputs. The inputs are quite unclear. And we thought an important issue like climate change, all of the challenges that face us as an investor and issuers as well, we need a better way to evaluate climate risks and how companies are transitioning. And so that was the genesis for us developing our climate risk model. And we've updated it every year since. There's a lot more information on our website, but I'll give you a high-level overview. The 2021 model, which has just been published by Insight, incorporates essentially five different data sets as inputs from the likes of CDP and 2-degree analysis, physical risk factors. In total, we're looking at 200 metrics in total. We see Scope 1 and Scope 2 and Scope 3 emissions as only being one aspect of measuring a company's climate risks. And because we take a much broader approach to looking at climate risk issues, it means we think we have a better understanding of where a company is failing and it's succeeding in its climate transition and which companies we need to be concerned about. And of course, if we take the oil and gas sector, because that's obviously the center of attention for many of our clients, we actually do see a range of performance. We see some issuers in emerging markets and the US where they score our lowest rating. But we also find in Europe, there's lots of leadership, lots of commitment, lots of action. And we therefore think it's unfair to treat the oil and gas sector with a simple blanket, they're all bad. Because actually what we identify is we identify there is leadership. We want to capture and support that change that companies are making. And this will be increasingly important as our clients commit and make sure that our mandates reflect their own commitments to be net zero. So going off in a bit more detail on our own climate risk model, we basically have two pillars. We have the transition pillar and we have the physical risk pillar. I think the physical risk pillar is largely understood, but for our purposes, it's just generally looking at how weather impacts, whether that's water shortages, fire risk, may create chronic or acute risks for companies. And we score each company in our analysis on those physical risk scales. And then there's a transition risk. And this is much more qualitatively driven. And this will look at factors such as the board of directors' commitments, the targets that are being set, as well as some of those Scope 1 emissions targets as well. And essentially, we bring in all of this information, weight the categories, generate scores across all these different key factors and different signals, which might be binary, it could be scenario focused, and essentially we will generate a rating on a 1 to 5 basis. And the purpose behind this quite advanced modeling isn't to make the issue of climate change complex to understand for us, because it's already complex enough. It's in order to distill all of this information and put it in language which we can understand and communicate effectively with each other, and also enable us to target engagements much more effectively. We do know that we have a responsibility to engage with companies, but because our resources are always very stretched, we can't engage with every company on every issue. So we focus on what's relevant. And that means that our credit analysts, as well as the ESG team, know where to prioritize and know which engagement themes we should be tackling with companies. So that really has been a really effective process over the last 4 years. And we think that there are great advantages to developing these type of models, but perhaps it's just worth finishing with some of the challenges. I know that we've already spoken about it already, but the data challenges do exist. We do find there's lots of data gaps. there is an unequal amount of disclosure. You've got lots of large listed companies very committed to environmental information, but you don't see that across the board. And so we're very supportive of efforts in the EU to accelerate the amount of disclosure coming from European companies. And we hope that through that work, we will start to see a greater amount of information that can be standardized and allow us to effectively evaluate companies and use this information to help build portfolios that align with our clients' needs.
Thank you, Josh. Very comprehensive. And Salima, earlier on, you already gave some context to the partnership you have at AllianceBernstein with Columbia University's Earth Institute. I wonder if you could elaborate on that and sort of what have been, I guess, the benefits of bringing in an academic perspective to transition.
Sure. So in understanding climate risks, we talk about physical risks, we talk about transition risks. What is a lot harder to modelize is sort of second effect risks from climate change. So to give you an example, you can start from a high drought year in 2010 that led to the crop harvest in Russia being lower than average. This led to higher crop prices. This then fed into an increase of the price of bread into the Middle East, which then fed into the Arab Spring, which then led to a spike in the price of oil, which then enabled shale producers in the US to become profitable and start drilling, which then led to the subsequent collapse in oil prices. So understanding this second, third degree effect and modelizing those are the type of things that we work with Columbia on. In trying to understand transition risks specifically for both companies and countries that we look at, the main prism through which we try to make this assessment is the concept of materiality. So as Anna alluded to, there are several environmental factors that we look at. We look at carbon, but we also look at, depending on the industry, we look at biodiversity, we look at waste, we look at water, we look at where are the end goals of these companies, where are the end goals, and then where are the milestones to get to that end goal. We also look at how the companies intend to get there. So for example, a company may have a decarbonization plan aligned with 1.5 degrees, but if a meaningful part of how they try to get to this decarbonization is through the purchase of carbon offsets, well, that's not really feasible if everyone tries to follow that pathway. So we look at this. We look at the ambition of the target. Obviously, alignment with net carbon zero by 2050 is important. Paris alignment actually only translates into a 3-degree warming scenario. So for those issuers that have decarbonization strategy aligned with Paris or 2 degrees as opposed to 1.5 degrees, we want to understand how and if they have it in the plans to be more ambitious. And that's something that is, where engagement is key. And having fundamental analysts undertake the ESG integration work and scoring the credits that they cover individually in E, S, and G is key to make that engagement as effective as possible. We look at the different, with regards to decarbonization specifically, we look at the different data sources available. So with regards to decarbonization pathways, we look at the Transition Pathway Initiative, we look at the Science-Based Targets Initiative, but we are also cognizant of the pitfalls that some of these data sources can have, despite being incredibly useful to us. For SBTI, we understand that a lot of the assessment that they undertake only pertains to Scope 1 and 2, which is very relevant for certain industries, but for others may only represent a very small percentage of the overall emissions. And so looking at a specific company within a specific industry through the greenhouse gas emission Scope 1 and 2 may be irrelevant, whereas looking at a utility through the Scope 1 and 2 prism is actually very relevant because most of the emissions for a utility company comes from Scope 1. So those are all types of areas that we look at, and where we have ongoing engagement with Colombia on. And that partnership has been very, very valuable to us over the past couple of years. And we are partnering with them further to understand risks for some of the more esoteric credits that we look at within our fixed income universe. I mean, we are a house that is very well known for their high yield and emerging markets franchise and their securitized franchise. So those are all areas where the disclosures, as Joshua mentioned, may be slightly behind, if not meaningfully behind average. And developing these risks model where we can, from the outside, have some understanding of the risks, albeit not to the same degree that we would have for the larger issues, which have a high degree of disclosure, is very valuable to us. And then finally, I would like to echo some of Joshua's comment about the technical standards screening criteria for the EU taxonomy. We think these provide a very powerful standardized framework for companies to issue in accordance with. And our hope, I guess, is considering the size of the AUM managed out of Luxembourg for retail funds, and the AUM managed for European clients, issuers outside of Europe may also be incentivized to disclose in accordance with these criteria, which will in turn allow us to compare like for like a lot more effectively.
Great, thank you very much, Salima. And I guess just turning to you, Natalie, and I think one or two speakers mentioned this earlier, but of course, ICMA last month came out with a transition finance handbook. How do you think that will shape standard setting and investment analysis around transition strategies?
Yes, sure. Well, having been a member of the subgroup of the ICMA that work on the paper, I can only say that it's a great paper, but I'm going to try to give you an unbiased answer, and actually a bit more from the analyst that I am, and which are focused on use of proceed bonds. I think that this paper is very additive when it comes to assessing the issuer transition pathway. Because through its 4 recommendations, it clarifies the issuer's disclosure requirements regarding transitioning strategies, and it brings standardizations. Currently, it's a very time-consuming process and a very difficult process. In our industry, we say data is gold, but this is really that. I mean, it's really hard to find data and actually to compare the data from an issuer to another. So I hope this paper will help on that, by promoting the TCFD disclosure format, by requiring issuer to set interim and long-term targets and to report on those targets. Also, it promotes, as I mentioned before, a larger scope of the disclosure, because it's encouraged the issuer to disclose evidence of a broader strategy to mitigate relevant social and environmental externalities, and how we contribute to the UN SDGs. So this is all very good things. Also, as mentioned by Salima, they underline the business model environmental materiality, which is key, because it's not relevant, for example, for banks to set target on scope 1 and 2, whereas their most important carbon footprint lays on scope 3. So it would be more interesting to see a bank that set target in terms of percentage of the, for instance, energy financing portfolio that is dedicated to renewable energy, for instance. I think also it's focused, as mentioned before by Salima and Joshua, on science. On science, and it also helped to compare one issuer from another, and also it promotes certification by a third party on the alignment of the target, so a very objective view of the target that are set. And another point that is quite important, I think that it encouraged companies to disclose information regarding the concrete action that they take to finance the transition pathway. I mean by that, again, we lack data when it comes to capex, opex, or R&D that's directly relevant to the company transition pathway. Sometimes it's very hard to figure out which part of the capex is dedicated to transition and which part is only business as usual. So I think in that sense, this document really helped to assess the transitioning from an issuer point of view. But now, that being said, being an analyst on use of proceeds bond mainly, not only, but mainly, I think there is one leg of the transition that is missing, which is actually, it's not very additive from an activity standpoint. My conviction is that, we are missing guidelines at activities level. There is currently no taxonomy nor definition widely accepted of what is a transition activities. So we need also further guidance, I think, to when it comes to what differ a green bond from a transition bonds. This is not very clear to me, and I think to very of my colleagues and competitors. Each investors have its own definition of transition bonds, and actually we are currently working on our own definition because we are convinced of the role that transition bonds can play, because they focus on high emitting industries. They very often offer higher additionality than green bonds when you take into account the geographical localization of projects. For instance, to me, replacing a coal power plant by a gas power plant in developing countries might bring a higher greenhouse gas emission reduction than financings, for instance, EV vehicles in Norway, where every second registered car is electric vehicles. So, of course, you have to take into account the risk of locking effect. But in this point, I think transition is very important, and we need a definition of what is a transition in activities, especially when it comes to when you look at the taxonomy. Where do transition bond position themselves versus the taxonomy? The taxonomy is very stringent, and there is a potential risk to create a risk market, a niche market with EU taxonomy compliant bonds, and that would coexist with non-compliant green bonds. So do we consider, non-taxonomy compliant green bonds as transition bonds? Do we view transition bonds issue as an intermediary phase for the issuer before it can issue green bonds? There are many questions to that. Also, the EU taxonomy has already defined what is transition activities. It's activities for which the threshold will evolved over time. So should use of proceeds bond that finance such activities be called transition bonds? Or if we look at the EU green bond standards, should those activities be financed through green bonds? There are many questions that need to be clarified. So I guess very useful document when it comes to assess the issuer transition pathway. But I think there is one leg missing regarding what we can define as a transition activities.
Thank you very much, Natalie. And that takes us quite naturally, really, into the final segment, focusing on the right debt instrument structures. And I'm keeping one eye on the clock here as well. But what I will do, and Natalie, you've given, I think, a clear and forceful argument for dedicated transition bond label. I'm keen to hear, I guess, everyone's views on this, and if you can keep it relatively punchy, just mindful of time. But let's start with Salima. How do you feel about transition finance instruments, and whether a additional bond label would be valuable?
So we have always been very skeptical of transition use of proceeds bonds. We believe they are redundant in a world where green bonds coexist with KPI-linked structures. For some of the reasons that Natalie outlined, there's no taxonomy for them. You cannot guarantee an improvement. The transition concept is forward-looking, and it's at issuer level. effectively. So you cannot really guarantee an overall improvement of the issuer. All you buy into is that they are investing in underlying projects that are not as dirty as they could be, because they wouldn't even be green. And also because, like for green bonds, the money is fungible, the impact effect is limited. So I think the danger of greenwashing is in these type of instruments is actually very high. We much prefer a KPI linked, the concept of the KPI linked bond. And the main reason for this is really it compels the issuer to stick to their transition plans. So imagine an oil and gas company issues a green bond, even invests in renewables. In 2 months' time, the price of oil goes back to $100 a barrel. All of a sudden, it becomes a lot more profitable to start drilling again. And what happens is the 500 million that they've raised in green finance is immaterial for a lot of the large players in the oil and gas space, and so they can just revert back to their ways with zero impact. Whereas with a KPI linked structure, and as part of our assessment framework for KPI linked bonds, we expect willingness from the issuer to transition a meaningful part of the capital structure towards their model. They have to weigh up veering off the sustainability path versus a direct monetary impact. And so we think those instruments are most suited for the sectors at the in the early part of their decarbonization process.
Clear. Thank you very much, Salima. Turning to you, Anna, how do you feel about the suite of transition finance instruments and the need for an additional label or sort of designated asset class?
I think that this kind of label may have a good place because the whole project of transition is so large that there is multiple sides that we can tackle it with in the finance industry. And do we want it or not, this non-official label, transition bonds, already appeared in the market. If we do not have a list of activities and standards and labeling, these bonds will still appear, but we cannot guarantee the quality, and they will undermine probably the good effort some of the companies will put into their transition bonds. If other companies will not be putting such an effort, or will not be as ambitious about their transition targets or their transition projects. I think this type of instruments are already popping up, and having standards, having label will be beneficial for the communication with our end clients, so they can build trust in such instruments. They can exist along with the sustainability linked, with KPI-based bonds, with the green bonds, but there are just so many types of activities that can be labeled as transition activities that I see a big market for this. I see a big opportunity for this label to establish itself. What we need is the standard.
Thank you, Anna. So I think that the current straw poll is 2 of the panel see merit and 1 of the panel doesn't. And Josh, you get the honor of giving your view in terms of transition finance and the merit of a transition bond label, or indeed the usefulness of existing technologies, I guess, to wrap up this part of the discussion.
Well, I'm quite ambivalent, so I'm not going to come down either way on whether they're good nor bad. Look, this is a very nascent part of the impact bond market, and so you're going to find some teething problems. And we've already identified today what some of those challenges are. But like anything new, the market will adapt, the guidance will emerge over time. So while I think at the moment I have my reservations, and we haven't seen many examples of great transition bonds or sustainability-linked bonds. The potential is there, and we recognise the need, and that the need is there largely because the transition challenge is huge. And if we're serious about decarbonising the economy, every company has to be part of that journey. It isn't just a privileged few like utilities who have to make that effort. It's every company. And if they have to demonstrate that by issuing a sustainability-linked bond, then they must do so. And so I think we would encourage issuers to think about sustainability-linked issuance. It isn't necessarily the right path for everybody. There might be other options, for example, a green bond, as Salim had mentioned. But I would leave on the table the possibility that a sustainability-linked bond may be the right option. But in order to do so, I would urge greater collaboration and discussion with investors. There are clearly a number of frameworks which are operating. Salima mentioned that AB have their own insights evaluating impact bonds since 2016. We've evaluated more than 300 of them, more than 100 in 2020 alone, or 2020 alone, sorry. So we clearly have expertise, we have knowledge on what we're looking for, and we're happy to share that guidance with companies because we all have to be part of this journey together. And if we're to service our own clients and our own stakeholders, then we're better off discussing these issues directly.
Thank you very much, Josh.